Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of LME 3-month nickel, zinc and tin. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of these patterns, levels, analysis or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that, LME 3-month nickel. The break higher during Christmas week, up over the gold long moving average, currently at 15,765, as well as over the key levels at 15,665 and 15,840, saw a significant release of bullish energy that had been pent up for about 2 years. This led to a complex coincidence of patterns over January of a quad top with individual pipe top and horn tops in there, and the main pattern being a January based dark blue ascending wedge pattern. The break lower from this pattern happened late 6 weeks ago and gave a primary downside target in the 17,400 zone, which was reached the same day. But a much harder to reach secondary target X1 is still down in the 16,075 zone. As far back as 4 weeks ago, I started questioning this secondary target and saying, and I quote, "This secondary target may be unobtainable for this pattern," end of quote. This is still the case now, but I will maintain target X1 for a few more weeks, as we went from one dark blue ascending wedge pattern straight into, at the end of January, into another similar setup, into a bright red February based possible ascending triangle or ascending wedge pattern, currently 17,205 to 18,230, and now possibly into a third pattern, a possible wide shallow, also bright red bull channel, currently 16,830 to 17,205. That could conceivably be part of a large late January bearish half hesitation pattern, with potential as far down as 15,750. We once again haven't triggered any of these patterns as yet, as we have, as I said 2 weeks ago, stayed above the 50% Fibonacci line at 16,515. A further point to consider is, as I also said 2 weeks ago, and I quote, "We may be running out of time to hit the trigger as well, as we have the green short medium moving average, currently at 17,470, moving up swiftly to meet the market," end of quote. I had a concern that the green medium moving average may be the trigger, short medium moving average may be the trigger for such a move. And this moving average has mixed it with the market, and though it might be delayed, so far there has not been any significant moves outside the bright red ascending triangle, come ascending wedge pattern, come bull channel, come halfway hesitation ideas. There's one other possibility, but it's a remote one right now, is to look at this bright red pattern as a possible bearish cat's ears pattern in construction. Such a pattern could easily see a drop down to the 50% Fibonacci line at 16,515 and make a double top after such a fall as we saw in late January, but have a more limited move lower than really any of the other patterns mentioned. This is just something to keep in the back of your mind, just in case we break on the downside. Whilst the onus may be on the downside, it does not stop, not yet at least, the idea of development on the top side. LME 3-month zinc. There had been here, and still are, a number of patterns affecting the market in recent times, all happening all at the same time. The first has been, and I still suppose is, the dark blue mid-July to early October 2025 bull channel, currently 31.96 to 34.09. However, this bull channel has been breached a number of times in the past, though the market has chosen once again to maintain itself within this pattern. The second pattern is the bright red May 23 to April 25 bullish Andrews pitchfork, and especially the middle time, currently at 33.73. This is the core bullish pattern here, as this middle time halted the rise 8 weeks ago along with the dark blue upper bull channel line. We're today once again back below it. Please bear in mind that the move higher was capped sort of by two 50% Fibonacci lines of the March 20 to March 22 move at 33.29 and 50% Fibonacci of the April 22 to May 23 move at 33.77. Please note these levels as we are pressuring them once again. Then there is a new pattern, a third pattern that emerged 6 weeks ago. The bright green mid-December last year to date, imperfect, bright green steeper bull channel, currently at 33.64 to 35.71. Last week we broke down through this bull channel. Unless it can be repaired swiftly, I will downgrade it next time. This all puts on notice of retirement the subsequent targets below, with the break of a primary target X down in the 31.89 zone, and the secondary harder to reach target X1 down in the 31.29 zone. However, there is also another pattern to consider, and is one that has taken its own sweet time in growing. It is a possible late January to date triple top pattern. My apologies. This derived from the earlier lopsided double top, though might still see it as a lopsided head and shoulders pattern, and I could see their point. After all, a head and shoulders pattern is a derivation of a triple top, but I tend to favour the triple top idea overall. For this one, well, despite the activity, it still hasn't been triggered. As I said last week, I would look for confirmed consecutive closes under at least 32.40 level to start even talking about potentials and targets below. So far this has not happened, and I will not develop this any further right now, other than to make you aware of it as a potential pattern idea. LME 3-month tin. We had a gapping higher move in mid-January that started a whole huge move higher seen later in January. The rise was fairly swift until the market breached the previous all-time high seen back in 2022 at 51,000. The day after this happened, the market started to fade. However, prices turned back higher just after mid-January, and we rose up to reach for a second time the one big old pattern, still even now dominating the market. The bright red upper time, currently at 58,330, of the big old 2020 to 2022 bullish shift pitchfork. This was tested 3 times but held as a resistance 6 weeks ago, and again over last weekend, which is very telling for a pattern that is between 4 to 6 years old. The move down following was a massive daily key reversal down at the top of the market, and we've followed on lower since. But we've met support on a closing basis from the rising green short medium moving average, currently at 48,612, which stopped last week from being a weekly key reversal down, a very telling point, which actually stopped that pattern happening. The key was, as I said last week, and I quote, if prices can drop below 46,700 by Friday, so that was last Friday, they didn't, and that's the end of quote. They did not, and we saw a reactionary daily key reversal up this past Monday. Okay, so in the bigger picture, over January and early February, the market created a head and shoulders pattern, one that looked like a head and shoulders top, but in reality became a head and shoulders continuation pattern. However, that was not all, as this head and shoulders pattern formed only one part, the first part, of a really massive looking double top, which we're in the final parts of constructing. The key level to look for is confirmed consecutive closes under the 50% Fibonacci line of the April 25 to January 26 move at 43,985. However, before we even look at that, we have something right in the market's face that needs to be dealt with, failed or overcome, and that is the previously mentioned rising green short medium moving average, an market which held up the market day and which held up the prices also last week. 3 weeks ago, prices did move and close below this moving average, but they did not sustain that move down, and that is why we have the huge spike up. Same as happened this past Monday. So this dynamic support is the one to pay close attention to. Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.